Hi everyone, and welcome back to Lendy's monthly financial and property update this month. We're in June. It's been a while since Dave and I have been here, and so it's really nice to be back, and we've got a lot to share with you today. We're going to cover, as always, the current property market, but more importantly, an update on interest rates are sitting today, and really whether we're expecting home loan rates to be moving up in the next little while. So in order to answer all these questions, we've invited back Lendy Group CEO David Hyman. David, welcome.
Thanks, Sarah. Thanks for having me.
Great. Well, let's dive right in. So Dave, could you first run us through a short summary of the property market and how it's performed in the last month or so?
Yeah, absolutely, Zara. Great place to start. So I think most people, unless they've been living under a rock for the last few months, would know that the property market is incredibly hot at the moment. We've seen very, very strong price movements in most of the capital cities. And in particular, if we sort of look at CoreLogic's May data, we saw increases at a national level of over 2.2% for the month. And just to underscore that, that's higher than what we saw in April, which was 1.8%. And to put it in context, the record month in that index was March at 2.8%. And to really kind of put a bit of color around all of that, these are monthly price movements. So if you just sort of compound them over a year, you're talking price growth well into the 20% range. Now, that's obviously, very, very elevated levels. And there's a few different things that are sort of underpinning that. We've obviously seen strong kind of rebound in economic activity off the back of all the COVID stimulus. So all of that stuff is washing through, and most of the economy is fully reopened, albeit we've had a few of those hiccups and snap lockdowns around the country. But all of that stimulus money is washing through the economy and helping boost confidence. And at the same time, the record low interest rates are ultimately driving significant demand for property. So it's sort of at a point where for renters, it often makes much more sense to buy the property they're living based on where interest rates are and ultimately what that means to their hip pocket every month. So we're seeing all of that stuff culminate together to drive a lot more demand. And at the same time, what we often see in times of high price rises is we sort of describe as seller FOMO. So if you're a seller and prices are rising significantly and there's not a lot of stock on market, it actually creates this Mexican standoff scenario where you're scared to put your property on the market because you don't know what you're going to buy, and you think by the time you sell and buy again, the prices have gone up by 10 or 20%. And as a result, we've got really, really low stock levels still. So a combination of high demand and low stock levels means that we've seen kind of record auction clearance rates and ultimately the resulting prices off the back of that. So I think when you look at all of that activity can't go on forever, but I think the underpinning fundamentals around why it's here today isn't changing in the short term. And when we sort of look through different segments, I guess one of the trends that's starting to emerge that we're certainly watching is we've seen 3 consecutive months of decreases in first home buyers. We've seen subsequent increases in investors. So we're definitely seeing some movements around the different segments that are playing in the market. And I think it's going to be interesting to watch as the first home loan deposit scheme is refreshed, I guess, on the 1st of July. There's 10,000 more places, whether that brings more first home buyers into the market. But certainly interesting market and lots of activity.
Thanks, Dave. Some really, really interesting insights there. One thing I did wanted to ask you, and I'm sure those listening are also curious, is we have seen some of the major lenders start to raise their fixed interest rates. So we saw CBA move their 4-year fixed, Westpac moved their 2-year fixed, both moved by 10 basis points, so a significant move. Could you share with us your thoughts of why this is happening? And is this a sign that the RBA may be putting the cash rate up a bit earlier than we might have expected?
Yeah, absolutely. So there's a couple of ways to think about the question. And the first one is really to sort of unpack a little bit around how fixed rates are set from a underlying cost perspective. So obviously there's 2 major types or main types of mortgage rates. You've got variable rates on one hand and you've got fixed rates on the other. And variable rates are very much, not so much pegged, but very much driven by the underlying cost of money or the cash rate. And that is set by the RBA on a monthly basis, and the banks typically follow with their variable rate moves in lockstep with the RBA. And we obviously haven't had many changes since the COVID decreases down to the current state of 10 basis points. When we look across the ditch to fixed rates are set by a couple of other forces. So typically they're relatively structured by the banks, and the banks buy what are called swaps, and those swaps cost the bank money. And they're typically taking a position on ultimately where rates will move over time. So what we've seen in recent kind of months is those swaps have become more expensive in the wholesale market. And some of that cost has been passed on to consumers. And the other aspect is in COVID, one of the stimulatory measures that the government introduced and really provided both low-cost funding but a lot of confidence in the market at the very, very onset of the pandemic was what's called the Term Funding Facility, which was a very, very large wholesale facility that the government provided through the RBA to the banks, which was ultimately a 3-year fixed rate funding facility. Now that comes to a conclusion in June this year, and is probably the second aspect that's caused some of those outer years, the 4 and 5 years in particular, fixed rate cost to increase. So I guess the summary there is, fixed rates are different to variable rates. And ultimately, from a variable rate perspective, the RBA's come out and publicly said that they won't look to raise the cash rate, which is ultimately the key driver under the variable rate, until at least 2024. Time will tell as to whether or not that plays out as true. And there's a few underlying measures or a few underlying drivers, things like inflation, unemployment, etc. And unemployment's heading in the right direction. We haven't yet seen significant increases in inflation, which would be the main kind of warning sign. But time will tell. I don't think anyone has the answer to that. We can really only at the moment go on what the RBA said publicly, which is that rates will stay low for some time yet.
With the possibility, though, of banks putting their interest rates up, as we've seen in the next few months, something that has come up a few times is customers being offered something they call a rate lock, kind of while they go through the process of refinancing. It'd be great just to get your thoughts on what exactly is a rate lock, and is it something that a customer should be pushing for, asking for, or steering clear of altogether?
Yeah, that's a really good question and quite topical actually. So firstly, a rate lock is effectively a product that you can ultimately buy when you're taking out your loan. And what it does is, in the event that the fixed rates move between the time of you signing your loan application and your loan ultimately getting funded, the bank will ultimately guarantee that you get that rate that was in market when you applied. Whereas if you didn't have rate lock, and let's say, for example, the product you're applying for was a fixed rate at 1.99%, and by the time your loan settled, that rate was really 2.19% on an equivalent basis, that's the rate that your loan would be on. With a rate lock, you get the 1.99%. And typically there's a small fee involved, typically in the order of hundreds of dollars, in order to secure your rate lock. What we'd say there is that effectively, in a falling market, it's not much of a concern because your risk as a borrower is relatively limited. In some cases, you actually benefit because by the time you get your loan, the rates have fallen. But in a rising market, and certainly on the fixed rate side, we have seen some movements there. If you're concerned about that rate moving 10 or 15 basis points, it's a relatively inexpensive and easy thing to do at the time of taking out your loan. So if you're not sure about that, we always recommend you speak to your broker or your home loan specialist. But very much in the market dynamics where we are now, where fixed rates are quite favoured and rates are potentially moving on the fixed rate side, it's definitely something that's worthwhile looking into.
Awesome. And finally, before you go, where are current interest rates sitting in the market at the moment, and can you give us a snapshot of any of those deals or offers that you guys are seeing?
Yeah, there's lots of deals and offers, and they're at record lows. So for those people watching or listening who haven't refinanced for more than 12 months, you should definitely take some time to take a look at your current rate and where these sit. So I guess just starting with some of the more compelling offers, and we mentioned fixed rates. The lowest fixed rates in the market are about 1.8%. There's plenty of offers at 1.9 and 1.99%, which is just very, very cheap money. And when we look at variable rates, they're sitting just above the 2% rate. And in some cases, we're seeing people achieve slightly below if they're in low risk segments or banks are particularly targeting those particular borrowers. We're also seeing lots and lots of in-market cashback offers. So you may have seen some of these advertised on TV or other alternative mediums, but these are things like the $2,000 or $4,000 cashback offers for taking out loans with particular banks. So Westpac and St George are offering $4,000 up to $4,000 cashbacks at the moment. and their fixed rates are sitting below 2%. So very, very compelling offering there. And some smaller lenders, or even, if you really do sort of take a view across the whole market, some smaller lenders are offering rates even more competitive than that. So we're very much seeing an incredibly competitive market driven by strong economic activity and very, very low rates of borrowing. Or low cost of borrowing. One of the catches or the lookouts at the moment, because of these incredibly low rates, a number of banks and lenders are experiencing very, very long wait times for approval. So the strong piece of advice from us is very much speak to your broker, speak to your home loan specialist around what your expectations there are, because oftentimes it makes a lot of sense to choose one of the lenders that's ultimately invested in their technology and process to deliver quick turnaround times. And your broker and home loan specialist can help you navigate that, because that changes on a daily and weekly basis.
Awesome. I think for everything we've talked about today, whether that's how the market's doing and certainly that first home buyer segment struggling a little bit, through to your rate locks, and then what deal should you be focusing on. I think the ultimate advice here is speak to the experts, talk to your broker or your home loan specialist, and they'll be able to guide you in a lot of these decisions. But Dave, as always, that was enormously helpful, very informative. So thank you very much.
Yeah, thanks, Zee. Thanks for having me.
And everyone who's out there watching, I hope you found that useful. As always, if you want to suggest topics for any of these updates, please feel free to add that in the comments below. But we hope you found this useful. We hope you enjoy the rest of June, and we'll see you back here for the July update. Take care.